Welcome to this pop-up Full Throttle, the Presidio Group's automotive industry podcast. I'm your host, Jason Stein, Presidio's managing director. On a regular basis, Full Throttle serves as the industry's meeting point for great conversations with leaders across the automotive world. Today, we go in-house with our guest, and it's all based on this. Financial performance of the average U.S. auto dealership is declining, and certain store values are under pressure as normalization from the industry's pandemic-era highs continues. That's what the Presidio Group's latest quarterly report said when it launched last week. The Q4 2023 edition of Presidio Perspectives, a quarterly outlook on auto retail and M&A trends, sums up the industry's performance in 2023 and provides an outlook on trends happening this year. Presidio's newest report details the latest developments in the short-term period we've dubbed the Great Normalization, the retreat of record profitability that occurred during the peak of the coronavirus pandemic. So what are we going to look at? Well, we'll start with the Presidio NCM Average Dealership Performance Benchmark, which is unique to this report, and then we'll continue on to the results of the Presidio Dealer Direction Survey and also look at M&A trends and the transaction outlook for the rest of the year. My guest on this pop-up podcast for Full Throttle is Presidio President George Karolis. Well, it's great to have my colleague on the program as a guest for the first time. He is George Karolis, President of the Presidio Group. Welcome in, George.
Thanks, Jason. Good to be here with you.
It's great to be here with you, and you've got a lot to share. We do. A quarterly outlook on auto retail and M&A trends is out. The fourth quarter 2023, we've got our arms around how the full year went and how the fourth quarter went, and I think it's summarized best with the headline, George. The Great Normalization continues. What does that mean?
That's right. Everyone was pretty excited to be a dealer in post-pandemic, especially in 21 and 22 with the record profits, which were driven by really a supply and demand imbalance. Inventory levels at very low historical levels due to shortages and production issues, and then consumer demand at highs. And that script has flipped recently over the last year and coming into where we are today, with inventories now, double where they were at the end of 2021. I think we're at a 57-day supply or so, which is nearly double. And we, in particular, imports are triple where they were just 2 years ago. And so inventory levels have come back closer to historical norms, and consumer demand is hampered because of inflation, high rates, and pressures on the consumers out there. So we have a double whammy, although it's not quite a falling knife like we've said. Profits are still 2.5 times higher on average at the average dealership since 2018, and dealers are still faring well, but they're having to work a little bit harder, as my partner Brody said, to make a little bit less. And again, this is brand and geography specific as well. So certain brands and geographies are faring better or worse than others. But we're very excited to have launched our inaugural quarterly report at the end of last year. And this is our second one for the the fourth quarter of 2023, and really excited to have that robust report out there.
And one of the key parts of launching the quarterly report, even late last year, and certainly now into a first full year results, is our partnership with NCM. And the Presidio NCM Average Dealership Performance Benchmark has told us an interesting tale to end 2023. What was that?
That's right. It can confirm what we're talking about here, which is profits are off, margins are off, the business is normalizing, but it is still at a higher level than pre-pandemic. On average, the average dealership profits are off 20% in 2023 versus 2022. That greatly varies depending on the segment that you're in. With luxury faring better than domestic, and import luxury was off a little over 12%. Versus domestic dealership profitability being off a little over 23%. So it varies, but it is confirming what we're seeing. Until we issued our report and our partnership with NCM, there was a little bit of a vacuum in terms of publicly available data, and the only information was just the public companies, which is about 6% of the total industry. NCM has about 25% of the dealerships in the U.S., and so it's a broader cross section. A little different, a lot more owners than just 6 owners. And so we're really excited to have partnered with NCM and be able to issue this data on a quarterly basis that kind of gives insight and helps a lot of dealers compare themselves to others.
And in fact, Paul Folletti, CEO of NCM, said as dealerships' operational metrics continue to decline from those extraordinary levels that you had mentioned, especially in the first few years of the pandemic, they're going to benefit by looking at how the results really stack up. And in a lot of areas, Paul said, dealers took their eye off the ball during COVID. Do you concur?
Definitely concur with Paul. I think, look, dealers made double to triple what they made historically, and we're rolling in the dough. I would like to say they hit the lottery in some cases, and so it was easy to get into some old bad habits. Take your eye off the ball a little bit. Spend a little bit more money, maybe pay people a little too much. Just spend more on things because you had extra profitability, extra cash rolling in, and so it's easy to kind of get into some bad habits when times are great. In our report, we talked about a lot of the things that dealers should be focusing on, to maintain profitability, minimize downside, and maximize the value and retain the value of their dealerships. And some of those things were expense management and focusing on F&I and making smart decisions, controlling inventory, and a lot of those things are the same things that dealers glean from NCM on a regular basis.
Speaking of data, it was this is now the second quarterly report where we've surveyed dealers, and we did it from January 19th through February 15th. And those aggregated responses came from 285 survey takers, about 3,100 franchise dealerships. It was a bigger, more varied pool of dealers than those who had participated in the inaugural survey last fall. And they had an interesting outlook, I guess, on where the direction of the market is going. Tell me a little bit about that.
Sure. Yeah. Look, we're excited about that survey as well. It's close to 20% of the total dealers in the country, dealerships in the country represented on a number of dealerships basis. And I think what we heard from most dealers is 2/3, which is a majority of the dealers surveyed, believe that profitability will be under pressure this year and likely decline. On the flip side, though dealers are still very optimistic, and some of the survey results, some of the questions about valuation were interesting. Where 40% of dealers, while 40% of dealers think values may decline, 40% think they may be unchanged, and 15% actually think they may go up. And so that tells us that dealers are a little bit more optimistic about the long-term value of dealerships. We also had some interesting information in the survey that we gleaned in terms of headwinds and what dealers are concerned about, and the top three headwinds that dealers are concerned about as we head into 2024 are interest rates and inflation, EV and EV strategy of certain OEMs, and finally vehicle affordability. So some really good information from that survey, which really helps inform dealers about general feelings of where we are today and where things are headed in the industry.
I thought it was interesting, George, on that survey. What's your interest level in buying dealerships over the next 12 months? And 31% basically said moderately interested, 25% said highly interested. So again, over half of those survey respondents are in the market.
That's right. Yeah, close to 60% interested in growing. But interestingly, the next largest number is neutral, which is not negative. They're not saying they're not interested. And so, from an M&A and acquisition perspective, still a general positive feeling out there, still generally a seller's market, but changing somewhat depending on, again, brand and geography and sentiment out there.
On the brand desirability ranking, something that we also launched last quarter, no surprise, Toyota and Lexus sitting at the top, but a couple of other surprises. What were those?
Yeah, no surprise on the flip side of that, which was Nissan and Stellantis kind of ticking down from a favorability perspective. I don't think that comes as a surprise to most. But it was not a surprise again to me, but we saw Subaru and Honda tick up the favorability rankings. In particular, those two brands have held their own and have been stable, and Honda, has really just been kind of a beacon there, and Subaru has really fared well, and especially in certain geographies. So we're seeing a lot of favorability in those two brands. Mercedes, a slight tick down. More so, we expect probably because of EV strategy, kind of current EV strategy, and where it's taken them, as well as sort of some of the OEM and dealer relations issues we hear out there, like ROFRs on deals and things like that.
So give me the final piece of the puzzle here, which is focused on M&A, and it's such a big part of the latest quarterly report as it was the last time. What are your real takeaways from M&A and where we are right now, and maybe where we're going for the next quarter?
I mean, 2023 was the third best, most active year from an M&A perspective for the retail automotive industry, and so it was a robust year, and we actually expect that pace to continue this year and well into the future. I think we've always talked about kind of the number of interested parties out there, and it's not just the publics. In fact, more than 9 out of 10 deals that happen are private to private dealers. Over 500 dealerships sold last year, over 350 actual transactions, and so pretty active. And we don't expect that to stop. There are hundreds of dealers interested in growing. In fact, in our survey, that was one of the main answers. There's a lot of private dealers that are looking to grow to diversify their portfolio, as well as provide opportunities for succession for their family and even operational talent within the organization. So we don't expect that to stop. Again, it'll vary a little bit by geography and by brand, and it might not be as easy as it was in the last few years, but still pretty robust and pretty in demand. Values are ticking down some, again, depending on geography and brand. But in some cases, values could even have gone up, depending on the brand. It's hard to predict and impossible to say this is exactly what's going to happen to values now or next month or even into the next 12 months, which is why it's really important to sort of have a kind of an expert approach to understanding the value of your dealership. At Presidio, we have 3 pillars of valuation and evaluation metrics, which has over 10 criteria in terms of what goes into understanding the earnings and the quality of the dealership. Earning kind of sustainability of earnings and geography and OEM relations. There's a lot of others, but there's a lot of moving parts to an individual unique dealership, and then of course the metrics to value a dealership. Blue sky, a lot of talk in the industry is solely focused on blue sky, but that's only one part of the equation. Only about 60% on average of the total value of a dealership, because there's real estate and other assets also. Yet most of the emphasis is on blue sky in the industry, and we sort of shy away from blue sky multiple talk. They haven't really changed much since consolidation began. They've been within a band, and what's really important is to understand the unique qualities of every individual dealership and what goes into valuing of that dealership, and sustainability of cash flows is one of the biggest moving pieces, but understanding and how to pin down and understand that cash flow stream and what it's going to be in the future is both an art and a science, and there's a lot to it. So we, now more than ever, because of the volatility of earnings, it's there's a lot of different ways to triangulate value. There's no one tried and true method, and so we look at every angle, including multiplier on revenues and kind of brand value and brand earnings potential, and then ultimately, what's most important is what's the ROI based on the value of an investment or the value of a dealership. And so it's important to triangulate, and there's no one set way to value a dealership, and it's a very unique and individualized process.
You hear the industry's best on the industry's best podcast, and you've heard from him today, George Karolis, president of the Presidio Group, and it is the quarterly outlook on auto retail and M&A trends, Presidio Perspectives, fourth quarter 2023. Go to thepresidiogroup.com. In order to find out more, you'll see it right there under News and Insights. George, thanks so much for being on the program.
Thanks, Jason. Appreciate it.
Thanks again to my guest, Presidio Group President George Karolis. And thanks for listening to this pop-up version of Full Throttle. Come back to us later in the month for our next interview on this platform. Email me with suggestions, jstein@thepresidiogroup.com, or go to the website, thepresidiogroup.com. You can follow us as well, of course, on LinkedIn. And go to Automotive News on Monday, April 8th to see an ad that Presidio Group has in the publication. It'll detail all things about the quarterly report. Thanks for listening to the program. We'll see you again next time.